Question 1. A company's $100 par value preferred stock with a dividend rate of 9.5% per year is currently priced at $103.26 per share. The company's earnings are expected to grow at an annual rate of 5% for the foreseeable future. The cost of the company's preferred stock is closest to cost of preferred stock equals dividend divided by price. 100 times 0.095 divided by 103.26 equals 9.2%. The answer is A. Question 2. We have an income statement with all these items. The degree of operating leverage is closest to DOL. Degree of operating leverage equals revenues minus variable operating cost divided by revenue minus variable operating costs minus fixed operating costs. And we put in the numbers and get 9.8 minus 7.2 divided by 9.8 minus 7.2 minus 1.5, and we get 2.36. So the degree of operating leverage is 2.36. The answer is B. Question 3. A 20-year $1,000 fixed rate non-callable bond with 8% annual coupons currently sells for $1105.94, assuming a 30% marginal tax rate and an additional risk premium for equity relative to debt of 5%. The cost of equity using the bond yield plus risk premium approach is closest to. First, determine the yield to maturity, which is the discount rate that sets the bond price to $1105.94 and is equal to 7%. This calculation can be done with a financial calculator. FV equals minus $1,000. PV equals $1105.94. N equals 20. PMT equals minus $80. And we solve for I, which will equal 7%. The bond yield plus risk premium approach is calculated by adding a risk premium to the cost of debt, i.e. the yield to maturity for the debt, making the cost of equity 12%. The answer is C. Question 4. Which of the following is most likely considered an example of matrix pricing when determining the cost of debt? A. Debt rating approach only. B. Yield to maturity approach only. C. Both the yield to maturity and the debt rating approaches. The debt rating approach is an example of matrix pricing. The answer is A. Question 5. A company's data are provided in the following table. We have cost of debt, cost of equity, debt to equity ratio, tax rate. The weighted average cost of capital is closest to. Convert the DE ratio to determine the weight of debt and equity as follows. Weight of debt equals DE ratio divided by 1 plus DE ratio. We put in the numbers and get 50% divided by 1 plus 50% equals 33.3%. Weight of equity equals 1 minus weight of debt equals 6.7%. WACC equals weight of debt times cost of debt times 1 minus tax rate plus weight of preferred stocks times cost of preferred stocks. Plus weight of equity times cost of equity. And we substitute in all the numbers and get 13%. The answer is A. Question 6. Which action is most likely considered a secondary source of liquidity? A. Renegotiating current debt contracts to lower interest payments. B. Increasing the efficiency of cash flow management. C. Increasing the availability of bank lines of credit. Renegotiating debt contracts is a secondary source of liquidity because it may affect the company's operating and financial positions. The answer is A. Question 7. The following information is available for a firm. The firm's degree of total leverage is closest to. So total degree of total leverage equals revenue minus variable cost divided by net income. From the question, we know the revenue is 800,000, variable cost is 400,000, and net income is 140,000. We put in all these numbers and get degree of total leverage of 2.86. The answer is B. Question 8. Business risk most likely incorporates operating risk and A. Interest rate risk, B. Sales risk, C. Financial risk. Business risk is the combination of sales risk and operating risk. The answer is B.